Hello everyone, this is Lori Wilson-Jewett with Utah Fusion Real Estate and CDA Properties. Today we're going to be interviewing an expert. Our expert is Angela Thorpe with Academy Mortgage, and we hope you enjoy our video. Utah Fusion Real Estate and CDA Properties, and today I'm so excited. I have Angela Thorpe with Academy Mortgage with me here.
Yes.
And this episode is about interviewing an expert. And I wanted to interview Angela so we can get some pointers for you on what you need to do when thinking about purchasing a home. So Angie, first of all, what does everybody need to know about what they need, what kind of documentation they need when applying for a mortgage?
Well, I kind of like to know the first thing you really need to know is a plan. If you have anybody who wants to look at buying a house, you need a plan. It's just like, I want to buy a house, but then you don't know how to get there. So I think the first part is just talking to a mortgage specialist to see what it looks like. And just because you talk to us doesn't mean you have to have your credit pulled.
Right.
You're just looking in a window, what does it look like? And then starting the plan of what it would look like to get there. Mm-hmm. On documentation, the standard documentation, it's 2 years of everything. So 2 years employment history, so you'd have W-2s, and then 2 pay stubs, everything's 2 months bank statements. Sometimes that can change if you're self-employed or 1099. We do taxes for 2 years. But there are so many different loans out there that we don't even need taxes for self-employed. So it's so broad of what you need. The most important part is just talking to someone, seeing what's available, seeing what will work for you, and making a plan and going from there.
That sounds great. Good information there. And why we want to know why, as buyers, we need to talk to a mortgage lender prior to going home shopping.
Well, first of all, your agent's time is very important.
Yes.
So when she's showing you a home, he or she
Yes.
is showing you a home, she wants to make sure if you fall in love. I always like to say when you move in, when you find that home and you basically start to figure out where the couch goes and the bed goes and
You're mentally moving
whose room is whose, that you write a contract that you can qualify. Second of all, most offers, if you don't have an approval letter that comes with it, they're not even going to look at it.
That is a true story. You just look like a much stronger buyer when you know in going what you can afford, what your budget is.
Yeah, I mean, they're not even going to look at the offer. Mm-hmm. So it's important so that they know once you go under contract, is it 2 weeks, 3 weeks, 4 weeks, 2 months, whatever you choose with the seller that you're going to close on that loan.
Yes.
And also I think the most important part, I've seen this a couple times where people kind of understand, I can buy this house, and then they find out what that payment is with that house, and they have a balk rate like, oh, there's just no way, even though they qualify, they're not comfortable. So making sure you know, hey, if we find that perfect house, that we know we can afford this much and we can afford the payment that goes along with it is
Yes.
really important.
We don't want to set you up for disappointment. You get all excited and then you're disappointed. So super important.
Yes.
Yes. What are some things that buyers might do, or are there ways for buyers to increase their credit scores? When preparing to purchase a home?
Yes, credit scores can have a big difference on rate, but more significantly on your mortgage insurance. Also, it can make a big difference on what you do qualify. The programs you qualify. So of course, the higher interest rate, the better you are at qualifying for the loan that you would like, or the better rates, or the bigger mortgage insurance. One of the biggest things that can help someone's credit, I've seen people with perfect credit but lower scores. And generally that means is their balance. Anything revolving is a credit line that can be paid to zero and charged back up. So if those balances are really close to the high credit limit, that will drop your score. I've seen people's score jump 100 points by just changing that balance of what the credit they owe and how much the balance is. So keeping that around below 25%, I would say 10% is optimal, but that might be hard to do.
Yes.
But 25% or lower helps your score out a lot.
So does a revolving line of credit help your credit score more as opposed to a car loan?
I would say a mix of everything.
Okay.
Credit comes up with a few things. It has your payment history, so paying on time, not having collections, your balances. Types of credit only have about 10% variance on your credit score. Length of credit history, so basically a credit score is a mathematical equation.
Okay.
And there's a different balance on old credit, new credit, credit that has a bankruptcy, credit that has a foreclosure, so they're all a little bit different. So, but really the biggest thing is make sure you make your payments on time. Make sure if you get a warning in the mail that says, hey, this is going to turn into a collection, you call and immediately jump on it. And the other one is keeping those revolving credit loans lower. I mean, about 10% to 25% of the high balance is optimal on that.
Good information. And I would think in my mind that about 6 months prior to wanting to purchase a home, or if you're planning to purchase a home, it's a good idea to get in contact with a mortgage lender to see what the picture looks like, what your credit profile looks like.
Definitely. And you have 6 months. There's a lot of little tweaking you can do with credit scores or credit that, as I told you, you go from a 660 to a 720 or a 700 to 740 or 760, you're going to make a big difference in the mortgage insurance and the type of financing that you'll be able to get.
Okay, great to know. The big question that we're all wondering about today, what are mortgage rates doing these days? They've been so volatile.
Volatile. If you want to look at what interest rates are doing, just look at the stock market. The stock market is very volatile. You'll see it jump up and down, and we're seeing the same things. And we call them mortgage-backed securities. Just as if you were to go buy an Apple stock, you could go buy a mortgage-backed securities. And they are as volatile as every stock out there right now. So we will see swings rapidly up and down. I'm looking forward to where we see just little toggle changes every day. But right now it's still volatile. The economy is still dealing with inflation. CPI came out today that was much higher than expected. So anytime we start to see things higher than unexpected, things in the economy that are rough, recession you'll keep hearing about. If we don't, I'm not sure. Lots of economists you'll hear everybody say everything. But as long as we keep that volatility, the rates will be the same.
Okay, great information again. So with the interest rate increases, we have seen how much that can affect a mortgage payment monthly. And a lot of buyers have been, knocked out of the market because of the rate increases. So what does that look like on a 1% increase, say for example, on a payment? How does that affect your buying power or your purchase price, what you can afford?
Cheat sheet here. I kind of did some statistics. So I looked at the median sales price in the Salt Lake County area. This is medium. There's homes that are lower. There's homes that are a little higher. The median sales price is $530,000 for April. So when the rates were 3% back in December, we were looking at a principal and interest. This is just principal and interest. There's no mortgage insurance, tax insurance, just principal and interest on a $530,000 purchase price was $2,234. Now we're looking at the mid to upper sixes. So 6% on that same $530,000 purchase price is $31,777. a significant difference in what you're going to be paying each month. Almost $1,000 increase. As we look at that same 3% interest rate at the 530,000. At 3%, if we go to 6% to keep that payment at that 2,234, it's at 372,612.
Wow.
So a significant drop on keeping the same payment and what you can afford. And so that's what we're seeing as people that maybe were qualified November, December. Hey, you qualify for this 530, but now they're looking, hey, it's 372. So we are still seeing people buy homes. I've had people that were qualified and are still buying homes. Sometimes you have to adjust your home, but historically, real estate has always been a great place to invest. I mean, you get a lot of advantages with home buying. First of all, you get to, instead of making someone else's mortgage payment, you're making yours.
Investing in yourself.
Yes. Every month, instead of it just going like to rent, part of that payment goes to principal reduction, meaning you owe less every month. Every month it's significantly, a little bit less. The other thing is you get the tax advantages, especially someone that's in the upper tax bracket. Just having that mortgage interest would prop you into another tax bracket. So even though you may be paying a little bit more in principal and interest payment, your payment that you were paying rent, you're to take for a tax bracket, which really equates that you're making about the same payment. Yeah. So it really just depends on the client.
Right. That's great information. I want to thank Angela for being here with us today. And please, if any of you are interested in finding more information out about mortgage financing or getting pre-qualified for a home, please feel free to contact us. And thank you again for watching my video. Thank you so much for watching my video. Until next time, this is Lori Wilson-Jewett with Utah Fusion Real Estate and CDA Properties, where you and your real estate dreams come together.